Today, we will talk about the 3(c)(7) exemption. The 3(7) exemption refers to a portion of the Investment Company Act of 1940 that allows private investment companies an exemption from some Securities and Exchange Commission (SEC) regulation, providing that they meet certain criteria. 3(c)(7) is shorthand for the 3(c)(7) exemption. The exemption, found in Section 3 of the Act, reads in part, "To qualify for the 3(c)(7) exemption, the private investment company must show that they have no plans of making an initial public offering and that their investors are qualified purchasers." A qualified purchaser is a higher standard than an accredited investor. It requires that the investor owns not less than $5 million in investments. The term / Both 3(c)(7) and 3(c)(1) funds are exempted from the requirements imposed on investment companies under the Investment Company Act of 1940. However, there are important differences between them. 3(c)(7) funds, as noted, take investments from qualified purchasers, whereas 3(c)(1) funds work with accredited investors. Investors in 3(c)(7) funds are held to a higher wealth measure than those in 3(c)(1) funds, which can limit the investor pool that a fund is hoping to raise money from. That said, 3(c)(1) funds are capped at 100 investors total, limiting the number of investors the fund can take in from the wider pool they are allowed to pull from. Here are 4 key takeaways. 1. The 3(c)(7) exemption refers to the Investment Company Act of 1940 section permitting qualifying private funds an exemption from certain SEC regulations. 2. Private funds must not plan to issue an IPO and their investors must be qualified purchasers to qualify for the 3(c)(7) exemption. 3. There is no maximum limit for the number of purchasers of 3(c)(7) funds. 4. In contrast to 3(c)(7), 3(c)(1) funds deal with no more than 100 accredited investors. Hope this would help. Thanks for watching.